Hi, and welcome back to the Food Fund, where we analyze investing in food stocks, beverage stocks, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. Is the world's most popular coffee shop a good investment? In this video we will be analyzing if Starbucks stock is a buy. Could Starbucks, stock ticker symbol SBUX, be on the move for a return to glory? Let's find out. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Starbucks. Starbucks was founded in 1971 in Seattle's Pike Place market, starting as a single store selling roasted coffee beans. The company has grown into a global coffeehouse chain with a massive presence. Expanding from their core of coffee, Starbucks offers a wide variety of hot and cold beverages, along with pastries, sandwiches, and even light lunch options. Today the company has over 35,000 stores in 80 countries in prime locations and employs over 400,000 people. Now let's look at the price action. Starting with the 1-year chart, we see that Starbucks had a CAGR of about -15%. Zooming out to the 5-year chart, we see that Starbucks had a CAGR of 4%. Starbucks share price had been a steady climber but has pulled back recently. This may represent a buying opportunity. If we perform a backtest comparison of investing $10,000 in Starbucks versus the S&P 500, we find some interesting results for Starbucks. In that comparison with the S&P 500, $10,000 invested in Starbucks would have grown to $15,769 or a 9% CAGR versus $22,796 or a 17% CAGR if invested in the S&P 500. This demonstrates underperformance for Starbucks. A Starbucks investment would have also been more volatile with a 27% standard deviation versus 18% for the S&P 500. Starbucks outperformed the S&P 500 in terms of the best year performance, for which Starbucks grew 39% versus S&P 500 31%, and worst year performance where Starbucks fell only 13% versus the S&P 500 18% fall. In terms of max drawdown, Starbucks fell 37%, more than the max drawdown of 24% for the S&P 500. Starbucks did underperform the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio due to its excess volatility. Now let's hop over to market share and take a look at Starbucks' market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under restaurants and see that Starbucks is categorized under fast food restaurants. Expanding the fast food restaurants tab, we can see that Starbucks has the largest market share and actually appears to be growing. Let's look closer at the year-by-year changes in market share. So we come down here and type in the ticker symbol for Starbucks and see that the market share is 3.85% out of the publicly traded food, beverage, and restaurant stocks currently in the market. Starbucks attracts a significant portion of food spend. The 5-year market share CAGR for Starbucks is 4.26%. This means that Starbucks' market share has been steadily growing over time despite its market dominance. If we start in 2019, we see that the market share was 3.26%, 3.28% in 2020, 3.48% in 2021, 3.5% in 2022. And rose to 3.85% over the trailing 12 months. From this it is really clear that Starbucks is a juggernaut company. In this version of market share, we can also compare Starbucks with other companies or entire industries. When we type in restaurants, we can compare the market share data for Starbucks among the entire restaurant industry. Starbucks holds an amazingly dominant 25% share of restaurant spend. To put that in perspective, 25 cents of every dollar spent at a restaurant goes to Starbucks. Just wow. Let's take a look at the fundamentals to learn more. Gross margin is 28%. This is on par with expectations. Revenue has compounded at around 8% over the past 5 years and has reached over $36.7 billion most recently. This is so sweet. Looking at cash flow, we see a 7% CAGR over the last 5 years for operating cash flow, while capex has worsened at a 7% CAGR. As a result, free cash flow has grown at a 7% CAGR. Despite capex increasing as Starbucks continues to expand, the investment seems to be worth it. Weighted average shares outstanding have fallen over the last 5 years, going from 1.23 billion shares in 2019 to 1.148 billion shares most recently. Starbucks has been buying back a lot of shares. Their commitment to share buybacks is beautiful and is a big reason why so many investors love the company. Heart eyes. Now let's view return on invested capital. Return on invested capital has fallen from 19.5% in 2019 to 15.3% in 2023. This is not ideal. Starbucks has become less efficient in driving profits from its investments, though this trend bottomed in 2020 and has been pretty consistently improving for a few years now. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 17 days in 2019 to 18 days most recently, Starbucks has gotten a little less efficient over time. Similar to return on invested capital, cash conversion cycle hit its worst value in 2020 and has been improving since. I really like this trend. Now, let's look at Starbucks' debt. The net debt to EBITDA has increased over the past 5 years, going from 1.6 in 2019 to 2.9 most recently. While this debt level is not high, I prefer no debt in most situations. Last, let's explore dividends. Current dividend yield is a nice 2.4% with a dividend payout percentage of 59%. Starbucks is paying out dividends that its earnings can support. This indicates that the company's dividend practice should be sustainable. Dividends per share for this company have grown at a 9.8% dividend per share CAGR over the past 5 years and a 16.7% dividend per share CAGR over the past 10 years. The rate of dividend growth has slowed over time, but 10% is still pretty good. The fundamentals of Starbucks are great. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Starbucks. It is a restaurant company with a gross margin of 28%. The 5-year revenue per share CAGR is 10% and the 5-year free cash flow per share CAGR is 9%. This is great. Strong revenue growth and strong free cash flow growth. I like it. A return on invested capital of 15% is okay, but it is growing. Next, the cash conversion cycle of 18 days is not bad but is continuing to improve. Concerning debt, a net debt to EBITDA of 2.9 means that it would take Starbucks nearly 3 years of earnings to pay back their debt. So from a fundamental standpoint, Starbucks looks really nice. Now let's switch our attention over to valuation. Starbucks is undervalued relative to the S&P 500 with a ratio of 0.8. The price to earnings growth, or PEG ratio, is 1.5, indicating that Starbucks is overvalued relative to their projected earnings growth. Starbucks has been such a phenomenal growth story over the past 30 years that I am truly surprised when I see the company continuing to find new avenues for high quality growth. Case in point, the market share expansion is truly amazing given that Starbucks not only has the largest market share of fast food restaurants, but they have the largest market share of all publicly traded restaurants. And they are still expanding market share at a healthy pace. Some of those drivers for growth seem to be international expansion. Starbucks in India, a joint venture with retail giant Tata, recently announced their 400th store in the country, marking a wonderful achievement for the company. On the other hand, challenges still exist in China with growing competition and regulatory overhangs. I am optimistic that the company will continue to thrive in China, though maybe not at the same growth as in the past. Outside of those drivers, Starbucks continues to be a strong company. The recent share price pullback is making this an even sweeter buying opportunity in my humble opinion. For me, Starbucks for sure is going on the watch list. Many thanks for watching. What do you think about Starbucks, and please be sure to let me know what other companies you want me to analyze. Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.